Hello there. Welcome to this Ultimate Forex Trading course. This course will teach you everything you need to know from beginning to end. It's perfect for new traders, people interested in trading or Forex trading. It's also good for those who have learned the basics but are struggling and perhaps need to go back to basics and fill in any holes. Welcome, my name is Samuel Morton. A few things before we get started. The first thing that I'll mention is I'm a Forex trader. I've been trading for about 15 years. I love it. I would never do anything else. I don't just trade Forex. I also invest in stocks and shares. I trade futures. Sometimes I dabble in commodities, but not very often. But my name has really been made in Forex trading. So that's a bit about me. I'm one of the very few trading educators that has verified trading results. This is my YouTube channel. I have a website, actualforextrading.com. Another thing to mention before we get started, please have something you can make notes on. If you're serious about trading, you really need to be taking notes. Don't just watch this video without taking any notes, or at least making some action points, some goals, things you're going to do after watching this video. This may be the longest video I've ever recorded, so bear with me. It is hot. I do have my whiskey glass that doesn't have whiskey in, has sparkling water with ice and a bit of lemon. Okay, I think that's everything. Anything along the way, anything that doesn't make sense, let me know in the comment section below. I will be responding to comments, so if you have questions, leave them below and I'll get back to you. I guess one thing I should mention before we begin is you're not going to be ready to start trading Forex after watching this video. Even though this is the ultimate course and I'm going to teach you everything you need to know, you will need to dive a bit deeper into every subject and do your own study and obviously practice what I'm teaching you. I have more content on every aspect that will be covered, but let's start with this slide. So keys to successful trading. These are the 5 steps that you'll need to make. These are the 5 steps you'll need to take in order to be ready to start trading. So learn the basics, number 1. Learn the basics. And I'll be covering all of the basics in this video, in this course. But like I said, you will have to dive a bit deeper. Learning the basics is going to take a long time. Don't expect to learn the basics within a few days or within a week. There is so much to learn. You have to learn all about price charts and how to read price charts, how to use a trading platform, what a Forex broker is, fundamental analysis, which is economic events and news indicators which can impact the markets, and so much more. There is a lot for you to learn. Please don't feel overwhelmed though. I'm here to help you, and all of my content is for free. When it comes to the basics, you can learn everything for free, and all that material is on my website, and I'll cover some of that as this video goes on. Step 2 is to practice. So you need to practice what you've learned. Once you've understood the basics and you have access to a trading platform, then you need to practice what you've learned on a demo account, which is number 3. So use a demo account and get some virtual experience of trading the markets. Once again, this is going to take a long time. This is not going to be you for an hour on a demo platform. It may be days, weeks, even months of practice on like a paper trading account, so you're not risking real money. Building on the basics, and then having some sort of trading strategy. So these are your 5 steps to success. And if you want a copy of this slide, then just let me know and I can email it to you. Best to email me, samuel@love-the-pips.com. Pips, P-I-P-S. So samuel@love-the-pips.com. My email is also on my website, actualforextrading.com. Now, to make this easier for you, what I have done is I've created a Forex trading checklist for you. Let's bring that up. So if you head over to my website, actualforextrading.com, if you click on free stuff and then go to step 1, which is here, basics, near the top of this page, so just scroll down a little bit, is this free Forex trading checklist. If I click on that, you can download this checklist. You can even print it off if you want to. It will use a lot of ink. There's lots of black and green, but it's interactive, so you can save on your desktop. And as you complete these steps, you can actually tick the boxes. So it's fully interactive and you can tick these things. So everything that you'll need to learn, those 5 steps that were covered on that slide, are all incorporated into this checklist. Okay, so it's 2 pages and it's 18 steps. That 5 steps is kind of broken down into 18 tasks. And you can work your way through this. So once again, you can download this for free on my website. Okay, let's come out of here. So let's jump in. What is the first step you need to take in order to become a Forex trader? That is having the right expectations, which includes setting goals and making plans. So pause the video if you need to, but on your notepad, on your notes or your note app that you have on your phone, what are your goals? Write them down. Is it to make X amount per month, per year? Is it to just achieve Forex profitability, just to be able to make money from the Forex market? Is it to be a full-time trader? Write down your goals. And now write down your plan. How are you going to get there? It could be that you're going to watch this video, download that checklist and work through that checklist. That would be a really good start. I've been trading for 15 years. Please listen to me. What I've put on that checklist, the content that I've got for you, which is all for free, is a great place to start. Will give you a strong foundation. So write a plan. What is your plan? Now, it's really important that your expectations are realistic, because some people can fail in trading by getting this first step wrong. And that is, they have the wrong expectations. They're expecting too much. And because they expect too much from trading, they get frustrated, they make mistakes, they get discouraged, and they give up. So your expectations have to be realistic. So don't expect to make tons of cash and get rich very quick. I would also say don't expect to be profitable within the next year. If you're just starting your trading journey now, you're not going to be profitable within the next 12 months. It's a very steep learning curve and it's a very long learning curve. So you'll have to bear that in mind. Have the right expectations. If you have a date in mind that you want to become profitable, ensure it's at least 12 months away from today if you're starting your trading journey today. What I would also say is if your goal is to become a full-time trader, that is a very long-term goal. You need to have smaller goals, smaller milestones along the way, such as becoming profitable. That's probably the first goal you should have. And then making X amount, working toward becoming a full-time trader. Now, I have some questions for you. Self-evaluation. I've actually used this slide in a previous video, so if you've watched my other videos, this slide and some others will look familiar. So work through these questions and be honest with yourself. Am I willing to study? It's going to require a lot of study to become a trader. Can I commit 1 hour a day, 5 days a week? It's going to take time. If you were going to do a remote qualification, there is study, there is practice, there are exams. Thankfully, there's no exams with trading. But what I'm trying to say is it requires effort. And the more consistent you are, such as an hour a day, the better that learning curve will be. And the quicker you'll get to your goals. Do I have the self-motivation and ambition to continue despite setbacks and failures? There will be many. Trading is extremely difficult. It's one of the hardest things I've ever done. It is so hard. The statistic is 70 to 90% of traders fail. They don't make money. So to be within that 10 to 30% of winning traders, and it could even be smaller than that, 5% of winning traders, you really have to be determined. You really have to be willing to get back up when you take a hit, because you'll be taking lots of hits. Do I have some available money for trading education and to open a trading account? Now, a lot of this material is free. Well, all of it is for free, but I obviously do offer paid content too, which is a bit more extensive. You don't have to take that. There's no pressure to take that. But along the way, there will be times you want to pay out for things. There might be a certain trading platform that you want to subscribe to or something like that. So you need to have some money available for those things, and you need some money in order to open a trading account. You don't need a huge amount, but some brokers have like a minimum amount you need to put in to open an account. You also need a minimum amount in order to open trades. And I'd say that's about £500, €500, $500. Once again, this is a long-term thing. So if you don't have the money now, you need to work toward that. There needs to be another goal for you. You have no available money now to put into a trading account, to potentially pay out for platforms, software, trading education. Then that needs to be a goal. Write it down. You need to start putting money away for these things. Can I wait 6 to 12 months before seeing results? So you have to be patient. Trading is very much a game of patience. If I lose my trading funds, will I still be in a healthy state financially and emotionally? Please consider that, because you could lose your trading funds. If it's going to wipe you out, then trading is not for you. Or maybe not for you yet. You need to do a bit more saving and get yourself in a better place financially. Now, I don't mean to be negative. I don't mean to put you off trading. There's some very serious questions there that may make you do a double take, may make you reconsider Forex trading. That's not my intent. My intent is that you take this seriously and you know what to expect. Trading is amazing. I love it. It's really fun. Okay, and you're going to have a great time. But please be aware of the risks and everything that I've put here. Okay, so what is Forex? What is Forex trading? Forex is an abbreviation, or the abbreviation, for foreign exchange. The foreign exchange market. That is the currency market. So if you think of an actual market, if you go to a market with market stalls, and I'm thinking about my local market, there will be people selling fish and fruit and veg. There will be some stalls selling snacks and food. There'll be a stall that sells really cheap shoes. Okay, so I'm thinking about a typical market, and there'll be other things too. So a market is a place where buyers and sellers meet, where goods are exchanged. And the foreign exchange market, as well as the stock market and all other financial markets, are no different. They are a place, not necessarily a physical place, but they're like a domain. They're a place where things are bought and sold. And in the Forex market, the currency market, it's where currencies are bought and sold, where buyers and sellers meet. Why? Why trade Forex? Why go to that market and buy and sell currencies? Where it's all about making money. That's the whole point of it. If there's no money to be made in the Forex market, I wouldn't trade it. Why would I do that? Okay, so it's all about making money. Currencies change price, they fluctuate. The pound against the dollar used to be $2.20 to the pound when I went to America as a very little boy. It's now about $1.35, so $1.35 to the pound. These prices change. And if you know what you're doing, you can take advantage of these price fluctuations and make money. You can buy a currency when it's cheap, and you can sell it when it's worth more, and you make the difference. Okay, so that's why we trade. Now, how do we trade Forex? In order to trade currencies, you need to have access to the Forex market. And the only way you can gain access is through a broker. So a Forex broker grants you access, usually by offering a trading platform. And then on these trading platforms, you can buy and sell currencies through the broker. So that's how we do it. Now, there's another way you can interpret how do we trade Forex, and that is, how do we actually decide what to buy and sell? Well, that is the million-dollar question, isn't it? And that's what this course is about, and that's what you're going to spend your life doing as a trader is, how am I going to make money from this? What do I buy? When do I buy it? What do I sell? When do I sell it? I'm here to help you know how. Next slide, please. Okay, so let's carry on with the basics. Currencies are bought and sold in pairs. So the pound by itself, if you're looking at the price of a currency, unless you compared it to goods, the currency can't be priced. It can only be priced against another currency. So going back to my story of the pound being worth $2.20 when I was a wee lad, and now it's $1.35, I'm comparing the pound against the dollar. And that's how we trade Forex. We trade these Forex pairs, these currency pairs. So you have the pound against the dollar, you have the pound against the yen, you have the pound against the euro, the pound against the Australian dollar, and so on and so on. And the same with other currencies, the US dollar against the Swiss franc, the US dollar against the euro, the US dollar against the Canadian dollar. These currencies are traded in pairs. Now, the first currency within a Forex pair, the first one stated, so if you look on my slide here, I have euro US dollar. So that euro, that's the base currency. So for one base currency, how much do I get of the secondary currency, which is the second currency showing in that Forex pair? So euro, US dollar. Euro is the base currency. So for 1 euro, how many US dollars do I get? And currently, euro US dollar is 1.15. Okay, so for 1 euro, I get $1.15. Tomorrow that could be $1.16 or $1.14, $1.18 if there's a massive move. Okay, so euro, US dollar. Base currency, secondary currency. The last thing to mention on this slide is bullish and bearish. If a market is moving up, so if euro, US dollar is moving up, if the price is moving up, we would refer to that as a bullish market. It's moving up. And we can do the same with stocks and shares. So if Apple shares are rising, we'd call that bullish. And if you plan to buy euro US dollar because it's rising, you can call that being long. I'm bullish the market or I'm long the market. I'm long euro US dollar. There's lots of ways to say this. Alternatively, if euro US dollar is coming down, if Tesla shares are dropping, that is bearish. So a bearish market is a market that's depreciating. and you can refer to that as being short. I'm short Tesla. I'm short Euro US dollar. Prices are falling, they're coming down. So let's have a look at a trading platform. So this is a typical trading platform. This is called MetaTrader 4, which is a very popular Forex trading platform, and the broker I'm using is IC Markets. There is a link below in the description for IC Markets as well as other brokers, and you can download all this for free. Okay, so this is a free account and it's a demo account. You can see there's a 10,000 balance here. That's not real money, it's virtual money. And I can use this platform to buy and sell currencies. And you can see on the left here that I have currency pairs. Let's have a look at some of them. We have Australian dollar, US dollar. If I hover over, it gives you a full description of the currencies. This is Euro, US dollar. We have Euro pound here, so Euro Great British Pound. We have Pound JPY, so that's pound against the Japanese yen. Euro New Zealand dollar. And there's lots of pairs here. And you can see the prices. We have a buy and a sell price. So a buy, which is the ask, and a sell price, which is the bid. So this is a typical trading platform, and I can simply buy and sell currencies on this platform, as well as do other things such as look at price charts, and I'll be doing that a bit later in this video. Let's go back to the slides. So that is the bare basics of Forex trading. Now, I mentioned you should dive a bit deeper, and I also mentioned I have content that will help you dive deeper. So if you head over to my website, actualforextrading.com, if you click on free stuff, go back to step 1 where we were earlier, this page will help you dive deeper and learn more about these basics, these Forex trading basics. And what you can do is once you have worked through that, on your checklist, you'll be able to tick what is Forex trading, why trade, how to trade, currency pairs and pips. So pips is not something I covered, but it's covered in that course. Bullish and bearish, and then give a big tick here. You should have also set your goals, made your plans, so you can tick that too. We're making good progress. Obviously, it's going to take you time to work through that basics page. There's a lot for you to learn, and there's videos for you to watch as well as text to read. So take your time. There is no rush. As mentioned, patience is the key to successful trading. What is next? Technical analysis. What is technical analysis? Technical analysis is the study of price charts. And what is a price chart? What are price charts? They are a chart displaying the historical price data of a particular currency pair. And let me give you an example. So there's lots of back and forth. Let's bring up the trading platform again. So we're back on the MT4 trading platform with IC Markets. If I hover over currency pair, so US dollar, Canadian dollar, and right click, I can click chart window, which brings up a price chart. Alternatively, I can go to the top left here, file, new chart, choose the currency that I want, a chart for US dollar, Canadian dollar, and that will bring up a chart. And let me just make this a bit clearer for you. Okay, so this is a price chart. And what we have on this price chart is the date and time at the bottom here. So your x-axis, that bottom axis, is date and time. And then on the right, we have the price. And you'll be able to see that price is moving from day to day, hour to hour, and changing. What's great about these price charts is they can be as detailed or as simple as you want them to be. A few things I'll mention now. you can break down price anywhere, usually from a few seconds to a month. So if I really want to zoom into price, I can click on 15 minute here. So this gives me a breakdown per 15 minutes. So the date and time is a lot more expansive. So I'm focusing on the most recent action. Whereas if I go to a D1, so a day, I'm getting a much longer term view. So my 15 minute really covers the last few days of trading. My daily covers over a year of trading data. Technical analysis is all about studying these price charts to try and predict where future price is going to be. So we study these charts, and there's lots of things you can do to study them, and I'm here to help you. A lot of this course, a lot of this video will be about studying these price charts. There are things you can look for, things that you can do to these charts to help you predict future price. The real basics of technical analysis is price action. That is the foundation of technical analysis. And you'll hear this term a lot, price action. Now, I've been speaking for like 30 minutes. So if you need to get a drink, I'm going to have some of my clear whiskey, my sparkling water. If you need a drink, if you need a toilet, if you need to go and sort the kids out, whatever, go and do that. This is a good time to have a break. There's a lot of information to take in. If the video has been helpful so far, please like. Any questions, leave them below. If you want to show your support, just give me a nice comment, a supportive, encouraging comment below. Okay, what is price action? It is, as the name suggests, it's how price has acted. So going back to that price chart that we were looking at, all the moves up and down, that is price action. So looking at this US dollar, Canadian dollar chart, we can change the times like so, and all of this is price action. Now the key things you want to look for when it comes to price action is price trending or is it ranging? When price trends, it's moving in a general upward direction or a general downward direction. When price ranges, it moves in a general sideways direction. So is price uptrending? Is it downtrending? Or is it ranging? So moving up, moving down, or is it moving sideways? So looking at this price action here, this was around the 10th to the 17th of June 2025. You can see that price was coming down. So over time, price was moving lower. And this will be referred to as a downtrend. And what's interesting about these downtrends is price kind of swings. It's not just like one instant move from here down to here. It doesn't just fall strongly. Let's make that a bit clearer for you. Let's do it black. It doesn't just suddenly drop, though that can happen. What happens when price downtrends is it kind of waves. Okay, so it moves down, it moves up, it moves down, it moves up, it moves down, it moves up. It creates these waves, these steps. And these are called swings. So you swing low and you swing high. You swing low, you swing high. You swing low, you swing high. And the main characteristic of these swings is the swing lows are lower and the swing highs are lower. So if you look every time price swings up, we're actually lower and lower down the chart. And the swing lows. So the swing lows are lower and lower each time they come down. And that's the main characteristic of a downtrend, is these swings that move lower and lower. Now if we find an uptrend, you'll see it's the same sort of thing, but in reverse. So let's just look over here. So this is the 4-hour chart now, and we're looking at 21st of October to the end of the year, 31st of December. What's the direction of price? Well, it's coming up, isn't it? Over time, price has come up. And once again, you'll see that we had these swings, like we move down and up, and create these steps. And you'll see that we have these swing highs, so we swing up, and we have these swing lows, we swing down. The main characteristic of an uptrend is that these swings are higher and higher. So each time we peak, it's higher than the peak previous. So peak here, peak here, peak here, peak here. And the troughs, each time there's a new trough, it's higher than the trough previous. So the swings are higher. And I have a lot more material on this on that page that I showed you earlier. Now when price moves sideways, okay, let's see if we can find a nice sort of sideways. Let's go to the, say, the weekly. Okay, so if you look at this price data here, this price action, you'll see that from the end of May to March, this is a weekly chart, so there's a huge amount of data here from May 2015 to July 2021. It's a general sideways direction. So we started here and ended here. We ended where we pretty much started with regard to the price. So price hasn't been uptrending, hasn't been moving up from the left side of the chart to the right, hasn't been moving down from the left side of the chart to the right. We've just kind of moved sideways. You can see when price moves sideways, it kind of jumps all over the place. And what's interesting about these sideways markets is price generally moves between two areas of the market. So we can put a line up here, we can put a line down here. You see that price is kind of going from one side to the other. If you imagine like a tennis match, the ball started this side of the court, came up here, got hit back, got hit back again, got hit back again. So this is a sideways market. Generally, they're kind of very jumpy, but they just generally move in a sideways direction. Prices ranging. Another way to put this is prices consolidating. So what is price action? It's how price is acted. It's historical price movement. What is a range? What is a trend? You should be able to answer that in very simple terms. But please look into this deeper. The courses that I have on my website will cover these things in detail, and you'll be able to practice these things. If you download the MT4 trading platform, you can look at these things yourself and spot these things yourself, but you will need a bit more time first. There's a lot more you need to learn and work through the material on my website. Support and resistance, that's the next thing. What is support and resistance? Well, once again, let's go back to the trading platform. Support and resistance are areas within the market where price is supported from below or price gets resistance from above. So if we look back at this range, we could say this area down the bottom is a support area. Every time price reaches this support area, it reverses. It's holding up price. So around 121 here, there is a support. Every time price reaches 121, it reverses. How can that help you make money? Well, in very simple terms, you could buy at 121 because there's likely to be a reversal and price is likely to move higher. It's not as simple as that, but that is kind of the principle behind support and resistance, and part of the way you can use these price charts to predict future price movement. Resistance up here, so every time price reaches around here, 144, it reverses. It's a potential good sell area. Price has reached an area and it's likely to reverse. Let's try looking at a new chart. Let's get rid of this. Let's try pound US dollar. Okay, so pound US dollar. And let's try, say, a 4 hour, and just give me a moment to scan through. Let's see if we can find some very clear support and resistance. Okay, so if we were to look at this area here, which is around 140, let's just put it at 140. There we go. So $1.40 to the pound. You'll see that every time price reaches that line, that $1.40, it reverses. Let's bring some arrows in. Okay, so here, it's very small. Let's make that a bit bigger. And let's not have the same color as the price. Let's do dark blue. Okay, so price reached this 140 area and it reversed. Price reaches this 140 area again here and reverses. So we come up, we reverse. Price reaches this 140 again here and there's a reversal. Same thing happens over here. So this is a typical resistance, and it's a horizontal resistance, goes horizontally across the chart. Every time price reaches this horizontal resistance, it reverses. Look at it. This is how price charts can help you know where future price is going to be. Now obviously that resistance will break at some point. In this case it doesn't. You know, price really falls away from that area after this, but it's not guaranteed it's going to hold. You know, that resistance could break at some point and price could move higher. Now, it's the same with support, same principle. Let's see if we can find a nice support area. I might need to go to another chart. Okay, so we could, say, use this area, which is 128. And once again, let's use some arrows here. I want to make these even bigger, to be honest. I don't know how clear it's going to show on the video. So 128, price reaches 128 here and moves up. What happens next? Price reaches 128 here and moves up. So if you could spot this support zone, this horizontal support, then you potentially could just keep buying every time price reaches 128. That's kind of the principle, the idea behind this support and resistance. They're areas where price can reverse. And they're areas, not specific prices. You can see we reached here this time, we moved a bit lower this time, a bit higher this time. So it's like an area, not a specific price. Any questions? Leave them below. So that's horizontal support and resistance, these horizontal lines. You're getting a good demonstration of MetaTrader 4 in this video. Okay. There is also diagonal support and resistance. It's the same principle. Oh, what happened there? Let's go back. Same principle. Every time price reaches a diagonal area rather than a horizontal area, it can reverse. So look at this. Reversal, reversal. This is a diagonal support. Sometimes it's called a trend support. So price is uptrending, and each time it reaches this support area, it reverses. It's this trend support. And it's the same with resistance. Okay, so if I made a line here, it doesn't quite fit really, does it? But you could say every time price reaches this diagonal area, it acts as resistance. Let's find a nicer one though for you, a clearer one. Okay, so perhaps here you could say every time price reaches this diagonal area, we get a reversal. Let's bring those arrows back. So reverses, reverses, reverses. Okay. It eventually breaks. So it doesn't reverse here, price breaks higher. But what's interesting is when this resistance breaks, there's actually a reversal at it as support. Okay, so there's now a support area. And this is what happens with support and resistance. If a support breaks, it then can become resistance. If a resistance breaks, it can become support. The easiest way to think about it is floors and ceilings. Okay, so the ceiling above you stops you from moving any higher, but if you go up a floor, the ceiling becomes a floor. So it's the same with support and resistance. So if we looked at this sort of area here, this horizontal area, price reverses resistance, reverses resistance, reverses resistance. We can mark them with these arrows. Okay, so 1, 2, 3. It eventually breaks and is now a support. Okay, so this reversal area, when it eventually breaks, resistance turns support. There is a lot more to this. There's a lot that you can learn about support and resistance, and you need to practice this as well. So the best thing to do is work through the material on the website. So you're on step 2 now, which is technical analysis, and this will teach you all about trends and ranges and support and resistance, horizontal support and resistance, diagonal support and resistance. And then you can come to your checklist and you can tick things off as you've learned them. Now this is the same for everything we're going to cover in this video. I have courses and material on my website that will cover these things. I don't want to keep coming back to this checklist. I think I've gone through it enough times now. So I'll leave it alone. Let's just get rid of it. You'll work through and tick it off by going through the content on my website. You don't have to. You go to other websites to learn this material. It's up to you. It's just here to help you if you want it. That's support and resistance. Price patterns is next. Is this overwhelming? Is it going okay? I hope I'm not going things too quickly for you. Please don't feel overwhelmed. You can take your time. This video is a full course. It will teach you everything you need to know, but there's no reason why you can't rewatch it. And it's really just there to give you an introduction into trading and cover all the bases. You build on these things in your own time. So price patterns. Let's bring up a new chart. Price can form patterns. So it's not just support and resistance that we're looking for. Let's do Euro Australian dollar. Keep picking these random charts. So price patterns. Price can form patterns generally with the swings that it creates. So if you think of the trends again, where we have like these swings, these waves, these steps, if you can keep an eye on those waves, there are certain patterns that can form. And this is actually one of them here. By luck, one of them shows straight away. This is called a head and shoulder pattern. And what you have here is a shoulder and a head. Okay, so a head, a shoulder, and another shoulder. Okay, so if I was to draw a face, okay, so this is the head and shoulder pattern. A shoulder, they're big shoulders, aren't they? Perhaps you're shrugging. Think of someone shrugging. Shoulder, head, shoulder. Now the whole point of this head and shoulder pattern, or head and shoulders pattern, is it signals an uptrend becoming a downtrend. So you can see price was coming up. We have this head and shoulders pattern. Price then comes down with these lower swings. Lower swing highs, lower swing lows, lower peaks, lower troughs. So that's one pattern, and there are lots more patterns that you can learn. There are head and shoulder patterns that can signal a downtrend to an uptrend, and they are called inverted head and shoulder patterns. But let's see what we can find. See if anything spots, if anything stands out. Other patterns are double top patterns, and that's when you get two peaks like this. Once again, it signals a reversal. So an upward move becoming a downward move. You have these two peaks. Same happens with two troughs that are very similar. So a trough to here, and price reverses. This is a double top, this is a double bottom. So these patterns can signal that certain things are going to happen. So double bottom here, one bottom, two, price moves up. They signal these reversals. Top, top, so a double top, price moves down. Here's an inverted head and shoulder pattern. This is what I was looking for. So I won't draw the face this time for the sake of time, but we have a shoulder, so it's upside down. And the shoulder this side, so two shoulders, and then we have the head here. Okay, so think of someone shrugging again, very wide. This person is shoulder, head, shoulder. This signals a downtrend, so a downward market, a bearish market, becoming bullish. So if you were to spot this head and shoulder pattern, inverted head and shoulder pattern, you could say, oh, okay, this means that prices could start moving higher. This is a good time to buy. So price action doesn't just form these support and resistance areas, it also forms patterns. And we use technical analysis, we study these charts to look for these patterns. Next up is Japanese candlesticks. This is Australian dollar, Canadian dollar, same chart as before. This red line shows the price with the date and time down the bottom, the price to the right. If I change from this line chart to a candlestick chart, it looks like this. And I can zoom in using these buttons. Where are they gone here? Let's get rid of that. Okay, so instead of a line, that red line, I've now got something called candlesticks. And these candlesticks are fantastic. I love them. I think you're going to love candlesticks as well. A green candle means that price moved up. A red candle means price moved down. And what you have with these candlesticks, I'm going to have to bring up my drawing tool. There we go. What we have with these candlesticks is we have a body, which is like the bar. We also have these little wicks, top and bottom, these lines. Okay, so this current candle, this red body. And then we have a wick at the top and a very small wick at the bottom. And you can see it is moving a bit because this is the current candle. The way these candlesticks work is for a 1 hour chart, each candle represents a 1 hour of price movement, price action. If I move to a 4 hour chart, then one of these candles is every 4 hours. So after 4 hours, a candle will close and a new one will open. And the candle that's closed stays on the chart so you can analyze it. And that's what all these charts here, all these bars are here, are these candles that have closed. So you have a candle body and you have candle wicks. Being able to understand and read these candles can give you a signal where future price is going to be. And just to give you an idea of how they can be used, let's find some interesting candles. Okay, so this is one of the candles I want to go through, is just here. Is it going to disappear if I zoom in? No, it's here. So with this candle, what we have is a very small body. Okay, so for a very small green body, if you compare that to the bodies of other candles, it's very small. And we have a very long wick on one side. This is usually referred to as like a pin bar or a kangaroo tail. It has lots of names. But what it signals is this downward move can become an upward move. And you can see that happens soon after. So we come down, we have this pin bar, price moves up. We actually have another pin bar here. So a long tail on one side, so a single-sided tail with a small body, price moves up. let's say we can find some in reverse. Okay, so we want something like this. So we've got a small body with a long tail on the other side. This can signal that price was moving up and it's now going to move down. So just like patterns and support and resistance, these setups, that's what we call them, price action setups or Japanese candlestick setups, can show us where future price is going to be. There are other setups too, such as engulfing candles, and that is when a candle body, like this big green candle body, engulfs, overshadows the previous candle body. So this can signal price is going to move up. And the same in reverse. You can get these candles that are in reverse that can signal a move down. So this red candle body is bigger than the candle body previous. It engulfs it. So that signals price could move down, which it does. So we're about an hour into this. Once again, if you need a break, please take one. If you feel like you've learned enough and you want to start on the meat and work through those 3 courses, then please do. But I suggest you stick with this, work through to the end, and then you can go back and go through those courses. It is very hot in the UK at the moment, and my clear whiskey is getting very low. Any questions, let me know below. So moving on from price action. Technical analysis continued. You've learned about price action. The other element of technical analysis, which I haven't covered yet, is technical indicators. So there's indicators that you can add to charts which indicate, surprisingly, where future price is going to be. So on my Australian dollar, Canadian dollar chart, what I can do is add just some simple indicators. I'll do a moving average at 50. So that's this line that's appeared. There'll be another line that will appear in a minute. Indicators, trend, moving average. This one's going to be red. Yeah, let's do 25. Let's do 100. Okay. So the way these moving averages work is they can act as support and resistance. They can also signal where price is going to be. Now this pair is notoriously very choppy, very rangy. So let's actually find another chart. Euro pound is also another pair that's notoriously very choppy, like it ranges a lot, moves sideways a lot. Let's do what we haven't done US dollar, Japanese yen yet, so let's have a look here. And just bear with me, let me add those moving averages again. So insert indicators, trend, moving average. Got my red one. Let's do a green one. Okay, and let's do the daily chart. Okay, so there's a couple of ways you can use these moving averages. The first is when price reaches them, they can act as support and resistance. So you can see that when price kind of reaches these moving averages, quite often there's a reversal. So they act as support and resistance. When they're below price, they act as support. When they're above price, they act as resistance. Another way you can use these indicators is when the green is above the red, it means a bullish market, so price is going to move higher. And when the red, so like here, green is above the red, So we're bullish, we have an uptrend. When the red is above the green, it can signal a downtrend. Okay, and we have like this downtrend here, red above the green. We cross over, green above the red, we have an uptrend. There are lots more indicators that you can use. I like the RSI, so Relative Strength Index, which is an oscillator indicator. And the way this works is if this is very high, it can mean that the market's overbought and it's going to come down. If it's very low, like it is here, it can signal the market's oversold and price is going to move up. If I go into this in detail, this video is going to be hours and hours long. I have courses and content all about moving averages and RSIs and other technical indicators. Hopefully, I'm giving this enough time for you to get an understanding or just to see the benefit of using these things. Hopefully, at this point, you now feel like you understand technical analysis better than you did before watching this video. If not, I've absolutely failed. But hopefully you understand it a bit better and you feel motivated to look into this in greater detail. As mentioned earlier, you need a Forex broker to access the Forex market. You cannot trade Forex, you cannot buy and sell currencies without a broker. That's the primary purpose of having a broker, is so you can actually trade. Next slide, please. Forex broker basics. So what is a Forex broker? I think I've explained that many times. Why do you need a Forex broker? I think I've explained that many times. How do you get a Forex broker? I think the first thing to mention here is there are lots of scams out there. There are lots of broker scams. You have to be very careful. Choose a broker that's very well regulated or recommended by someone you can trust. Ideally, a broker is registered and regulated in the UK. I'm not just saying that because I'm British, but financial regulation in the UK is renowned. All of my brokers are FCA regulated, which is the financial body here in the UK. I never have issues. They're the best brokers in the world. In my opinion, I may be biased, but your funds will be safe and you should have a good trading experience if you're with a UK broker. There are lots of them. I have links below in the description. If you head over to my website and work through those courses, you'll eventually come across links. The one I've been using in this video is IC Markets, and it's an MT4 trading platform. These brokers will offer all sorts of platforms. MetaTrader is one of the most popular. There's TradingView, there's CTrader, there are others. What I suggest you do is just start very basic. Start with MetaTrader. And I have a MetaTrader guide on my website. You know, there's so much free material to help you through this process. Open a demo account, say with IC Markets or DarwinX, one of the brokers that I recommend. Once you've opened an account, you'll be able to open a demo account. So once you have an account with a broker, you should have like an online portal with them. You'll be able to log in on their website. You'll see a link where you can open a demo account. Once you've opened a demo account, the login details will be emailed to you. You'll be able to download the MetaTrader platform, which is generally in the email that you receive with the login details. And then you can open up the platform, and down at the bottom right here, you click on here, click login, and you just put in the details, which is going to be a login, a password, and a server. Once you've entered that, you click login, and you're good to go. You'll be able to choose currencies, Forex pairs, you'll be able to bring up charts, and you'll be able to do everything that I have gone through in this video. Because it's a demo account, you'll also be able to start buying and selling currency. So if I click one-click trading here, I can click buy US dollar yen, and then what it will do is open a US dollar yen position for me. So I've brought up here where this red line is, and the trade shows down the bottom. If I go to Euro Swiss franc and we click on buy. Okay, so once again, the position's now open and you can see a running profit and loss. As mentioned lots of times, there's a lot more to this. I'm going to stop mentioning this now. This will be the last time I mention it. There's a lot more to this. If you head over to my website, you'll get the real meat, the real details you need, the process to guide you through this. This is really the basics. Now there's another how question. So that was how do you get a brokerage account? How to use a broker? The next question really is, how do Forex brokers make money? Well, every time you open a trade, they charge a commission. Not all brokers, but a lot of Forex brokers will charge a commission every time you enter a trade. That's one way they make money. Another way that they make money is spreads. And if you remember the MT4 platform, the MetaTrader platform I showed you earlier, there was a buy price and a sell price. So there's a difference, and that's called a spread. So the difference between the market price and the price the broker is willing to buy and sell. They make money through those spreads. A couple of things to mention about spreads is spreads can be variable and they can be fixed. So variable spreads are always changing. That buy and sell price is sometimes very wide, sometimes very small. Fixed spreads, the spread is always the same. So if there is pound US dollar, it doesn't matter what time of day you're looking to trade, it doesn't matter what's happening in the world, the spread's always going to be the same. Fixed spreads are very rare nowadays. Most brokers offer variable spreads. Something to note is spreads widen. And your buying and selling is always based on the spread, not the actual market price. So if something is happening in the world which is causing spreads to widen, you're going to be paying a lot more for your trades. Another way to put that is, even though pound US dollar is 1.1567, you might be getting in at 1.1587 if spreads are that wide. So just be careful. When liquidity is low, when there's not many people actively trading, spreads widen. So what tends to happen is overnight US, UK time, so when Australia, Japan, Asia are trading, spreads are generally much wider and can get very wide because there's not as many people trading. You have to be aware of those things. It might be quite hard for you to comprehend at the moment, but this is something you will need to be aware of, and you'll learn these things as you start trading. Orders. So when you have a brokerage account, you can put in orders. So you don't have to buy at the current price or sell at the current price. You can place an order to tell the broker, okay, if price reaches, say, 0.9450, I want to buy then. I don't want to buy at the current price. So you can place these orders. What you can also do is tell your broker when to close a trade, if it's in a loss, and in how much loss, and the same with a take profit. So I've got my Euro Swiss franc here. Let's just close down US dollar yen. There we go. So Euro Swiss franc, currently £27 profit, but I have a commission here of £55. You're going to think that's a huge commission, but I've taken a massive trade here, far bigger than you should ever take. So this is bounced around back in profit now. You can set something called a stop loss. So I've bought at this price here. You can see the red line across the screen. I can set a stop loss to tell the broker, okay, if price reaches 93.40, so 93.40, then I want the position to be closed. So I have the other red line now. If price reaches this red line, the position will be closed in a loss, and I can adjust that to move a bit tighter. I can do the same with take profit. So I can tell the broker where if I want to be closed at 0.94, I put that in and I set that. Then when price reaches this dash line, it will close for profit. So you can set these orders. So you can now walk away from the chart if you wanted to, and the broker will close you at a loss or close you at a profit when those prices are reached. Going back to spread widening. These stop losses and take profits can be triggered based on that spread widening. As mentioned, the spread, so the difference between the buy and sell, is what the broker will use for you. It's not the market price. So if spreads suddenly got very wide, even though price on the chart doesn't reach this dash line, my stop loss, I could still be triggered at that stop loss. Due to that's the broker price, not the market price. I understand this is a lot to take in and it could be quite confusing if you're brand new to trading, which ideally a lot of you are if you're watching this video. So what I would say is if you have questions, leave them below. I'm here to help. Feel free to email me. But you will learn these things as you dive deeper and as you practice. So as you get your own trading platform and start trading, you'll be able to see these things in action. And generally the best way to learn is hands-on, isn't it? So as you're placing trades and placing orders, you'll learn these things. I mentioned regulation and scams. Ensure that your broker is well regulated, ideally FCA. And then leverage. So leverage, or trading on margin, allows you to trade with more money than you've got in your account. So my demo account may say £10,000, dollars, euros, but with leverage, I could actually be holding positions worth £100,000, $100,000, euros, with very high leverage, maybe even £500,000, $500,000, euros. The danger with leverage is you can lose a lot of money very quickly. You can also gain a lot of money very quickly. So it's very tempting to use leverage. There's a lot more about leverage on my website, but basically don't use too much leverage. 1 to 30, that's how it's displayed, is a ratio. 1 to 30 to 1 to 50 is generally adequate. You don't need anything more than that. If you're using, say, 1 to 500 leverage, be prepared to make some big losses very quickly. So try and keep your leverage fairly low. Demo trading. So at this point, you should have learned enough to actually start practicing what you've learned. So you've learned about the basics of Forex, the basics of technical analysis, and the basics of using a broker. So with that knowledge, you should be able to start your own demo trading account and practice what you've learned. Once you've done that and you're feeling comfortable and you feel like, okay, I can tick those things off the checklist and I feel comfortable, confident with those things, you would then move on to the next step, which is fundamental analysis. We are getting there. So we're just over halfway through this course. I think these last slides will be much quicker because I won't be bringing up price charts as much as I was. Fundamental analysis. So technical analysis is the study of price data in order to predict where future price is going to be. Fundamental analysis is the study of economic data to forecast where future prices are going to be. And when it comes to fundamental analysis, you need to focus on these things as well as items on the next slide. So central banks. Central banks are the bank of the economy. They are the bank, the organization that sets the monetary policy for that economy. So here in the UK, the central bank is the Bank of England. In the US, it's the Federal Reserve. Canada, Bank of Canada. Australia, it's the Reserve Bank of Australia. Japan, the Bank of Japan. I'm being tested, aren't I? So all these economies have these central banks. The reason why we need to know about these central banks and the decisions they make is their decisions can have a huge impact on the price of a currency. And one of the things that they do is interest rates. So I would say the main driving force of the Forex markets is interest rates. If interest rates are going to go up, that's going to impact a currency. If they're going to come down, that's going to impact a currency. Generally, lower rates, so bringing down rates, weakens a currency, and rising rates strengthens a currency. Generally speaking, there's lots of exceptions to that. Now, to forecast interest rates, you will need to track inflation for an economy and GDP growth. GDP growth is the economic growth of an economy. So GDP growth for the UK, GDP growth for the US. Same with inflation. Inflation for Australia, inflation for Japan. The reason why inflation and GDP growth are tracked, they have a huge influence on interest rates. And you've probably seen that in the news in recent years. So if inflation is climbing, if it's getting out of control, if it's too high, interest rates are likely to go up, which can strengthen a currency. If inflation's too low, then interest rates can come down. With GDP growth, if GDP growth is too low, rates can be cut to try and stimulate growth. If if GDP growth is very high, that's a good thing. Okay, so there generally isn't a rate change, but there's a lot of variables to this. I have a free course all about fundamental analysis, but tracking inflation and GDP growth to predict interest rate changes is a great way, is the ultimate way, in my opinion, to do fundamental analysis and predict where future prices are going to be. Now, there's a real danger here with fundamental analysis, and that is you learn technical analysis and you fall in love with technical analysis and you neglect fundamental analysis. That happens over and over again. I've seen so many traders do that. They learn all about technical analysis and neglect, or maybe don't do any fundamental analysis, and then it just comes back to bite them. So do fundamental analysis. You'll also need to track unemployment, retail sales, balance of trade. That's the trade between a country and its trading partners. You know, are they in deficit? Are they in surplus? PMI figures, they're generally for services and manufacturing, and they gauge whether those sectors are growing or contracting. Non-farm payrolls is a US payrolls figure. These things also can have an impact on interest rates. So there's something else that you will need to track and follow, which brings us into our next area, which is trading records. You'll need to keep a trading journal, and ideally a very sophisticated spreadsheet which won't just track the trades that you're taking and the result of those trades, but will also act as a tracker for your fundamental analysis. So what I have here is my tracker. So we have the country and we have the interest rate, the inflation rate, and I have the same for GDP growth, for unemployment rate. So you need to track these things. And what I also have is that information displayed on charts per currency. So this is for Australia. We have inflation, we have GDP growth, unemployment, PMIs, balance of trade, retail sales. This is probably very overwhelming. If you do not use Excel, you're going to think, I can't do this. Well, once again, I'm here to help you, and you can download this template all for free on my website. Going back to trading records and other records you should keep, you could keep something as simple as this when it comes to tracking trades. So your results per day and per month. I do suggest you have something a bit more detailed than this, especially in the beginning, such as why you took each trade. You can also create like an equity curve. So you're tracking performance over time. The more records you can keep and the more you can analyze your trades, the better. What you can also do is sign up for free to a couple of trade analysis packages such as MyFXBook. So check that out, myfxbook.com. Also Forex Factory. What you can do, you can connect your MT4, your MetaTrader platform, to that software, and it will keep a history of all your trades for you and create an equity curve for you. It's really good. If you trade with Darwin X, which is one of the brokers I recommend, they will do that for you on your online portal. They will show you your monthly performance. They will analyze all your trades, show you what your win rate is, give you lots of important information. So you need to have some way to review trades and have a journal, a history of all your trading, as well as a way to track your fundamental analysis. Right, we're really building momentum now. We're really getting through this. I just hope I'm not going too quickly for you. Once again, any questions, leave them below. Your next step would then go back to demo trading. So you traded demo with your technical analysis and with everything you learned, the basics of Forex. You are now demo trade again, combining your fundamental analysis and your technical analysis. That would be the next step, is you combine those things and then see how you perform. And you've got your trading records so you can keep track of your trades. Fantastic. I'm going through this step as in like 20 seconds. But the reality is this could be days, weeks, months of trading and keeping records. So don't think it's something that you should just glance over or do very quickly. Just because I've gone through it quickly, take your time. The more practice, the better. Practice makes perfect. But you'll never be perfect as a trader, unfortunately. Risk management. Okay, here we go. So once you're comfortable with fundamental analysis and technical analysis, well, let's actually see how that trade's doing. Euro, Swiss franc. Okay, so 300 quid. Let's just close that down. There we go. £300 in the kitty. Okay, I thought that'd be a bit of fun. Let's close this down now. I don't think I need this again. Risk management. To be successful as a trader, you have to manage your risk. You have to limit your risk. You really have to cap your risk. Keep risk to a minimum. There's lots that you can do to manage your risk. Sometimes it's called money management, not risk management. What you need to do to manage your risk, let me give you some ideas. Number one, plan how much you're going to risk per trade. So every trade that you open, you're going to risk, say, 1% of your account or 0.5% of your account. So going back to my demo account, which had £10,000 in it, it could be you're going to say, I'm going to risk £50, $50 per trade, and you stick with that. Okay, that's a good risk management strategy, is to have a set risk per trade. There are other things that you can do, such as I'm only going to take a certain amount of trades per day. I'm not going to hold trades over the weekend. That's not inherently bad to hold trades over the weekend, but what can happen with trades over the weekend is markets can gap over the weekend because they're closed. So the price might close here on Friday and reopen all the way down here on Monday, and you could get yourself in a bit of trouble if you hold a trade and that gap is against your trade. So it's something else that you can do. Trading with a well-regulated broker. FCA regulated broker is a good way to manage your risk. Your funds are safe. Only funding your trading account with what you're willing to lose is another way to manage your risk. If you put all your life savings into a trading account, that's a huge risk that you're taking. Only trade with money you're willing to lose. So there's a number of items there which you can consider to help you use strict, what I would consider common sense risk management. Trading psychology. Now this is a big one. There are two reasons why most traders fail, but there are actually three for this video, because the third one I want to add is not learning everything you should. So if you're not going to do every step in this course, you're setting yourself up for failure. Okay, I've been trading for 15 years, that's the truth. So that's one of the steps. Another reason why you will fail as a trader is this: trading psychology. Now, this may make no sense to you at the moment because you have no trading experience. But what happens when you start trading is you can get fearful, you lack confidence, so you don't pull the trigger and you miss out on opportunities. It could be that your analysis says that Euro Swiss franc is going to go all the way up here, but you cut it short because you're fearful of losing out on the profits you've already made. So that fear can kind of influence our trading decisions. The same can happen in opposite with greed. So you can get too greedy. I'm going to risk 30% on this trade because I really want to make £1,000 today. The emotion, that greedy emotion, is influencing your trading. Whenever these emotions influence our trading, we're setting ourselves up for failure. Impatience is another one. You get bored, you don't see opportunities, you start forcing opportunities to happen. That ultimately leads to failing trades and a failing trader. So fear, greed, impatience, these are negative trading emotions which influence our trading decisions, which are, like I said, ultimately leads to failure. So what a lot of traders, I would say 80% of losing traders, this is the cycle that they're stuck in, the loser's cycle. And that is they have some sort of trading strategy that they've created. Okay, they're doing their technical analysis, their fundamental analysis. They trade that, they become emotional, and then they give up. Because their emotions have led them to make mistakes, to make bigger risks than they should. So they're not seeing the results that they want to, and they give up. Some time passes and they try again. Perhaps they just tweak something about their technical analysis or their fundamental analysis. They trade that. They become emotional again. They give up. They then tweak something else. Okay, this tweak will sort things out. I'll trade. I'll become emotional and give up. So managing these emotions is a great way to ensure that you're consistent as a trader. But it's much harder than you may think. It's very difficult to manage those emotions, but there are things that you can do. Once again, I have content all about this on how to manage your emotions. One of them is this. Yes, if you lower your risk, you will be lowering your emotions. So your negative emotions and risk go hand in hand. The more risk you're taking, the higher your emotions will be, and vice versa. So one of the ways you can reduce emotions is to reduce risk. Another one, it goes back to step one, and that is expectations. If you have false, wrong, unfounded expectations, you're going to become emotional when those expectations are not met. So a couple of things to think about. Demo trading. So with your risk management and your trading emotional skills that you've learned, you can now trade again, see how you perform. Once again, this could be days, weeks, months in the making. But eventually, you want to get to this point where you have a trading strategy. And that is a set of rules that you follow that give you an edge. That there are certain things you look for on the price charts. It could be indicators with patterns. There are certain things you look for from a fundamental point of view. You want interest rates, you're forecasting interest rates to go up. You combine these things to give yourself an edge, to forecast where future price is going to be. Okay, so you've formed some sort of trading strategy. You create a set of trading rules. Without that, you're left to your own devices, and that's where emotions can come back into play. So another way to reduce trading emotions is to have a trading strategy. How you create a trading strategy, once again, you'll learn all about that when the time comes. There's no point me going into that now. It's just going to go over your head. But you need to create a trading strategy. You can also learn a trading strategy. So my Ultimate Forex course, which is the only exclusive content on my website, is that course. That will teach you how I trade, my trading strategy, so you can learn from others. But ultimately, you'll find technical analysis that you like. There might be support and resistance and candlesticks. You find fundamental analysis that you like, and you combine them together to try and give yourself an edge, to try and predict more often than not where future price is going to be. So you're right more often than not. That is it. So it took about an hour and a half, but that is it. That is your complete guide to learning Forex. Hopefully it's been helpful. I need to pour myself another clear whiskey, sparkling water with some ice, and a wedge, a lime wedge. I used to put lemon in, but I much prefer lime nowadays. Okay. So, my name's Samuel Morton. Thank you so much for watching. I understand we've been through a lot. As mentioned many times, I'm happy to answer your questions. Leave them below. If you haven't already, please like, please subscribe. I have loads of free content on my YouTube channel, including live trading videos. If you want to see me trade live, check those videos out. But ideally, what you would do from here is download that checklist on my website and just work through it by going through the content on my website. And I wish you all the best. I really do. It's incredibly hard to make it as a trader, but I do think you can do it with the correct guidance and the right mindset, which is being realistic and being determined, because you surely have to be determined to make it as a trader. Okay, all the best. I'll speak to you in another video.